I take this opportunity to welcome you once again. It is public relations topic. And in today's topic, we are going to look at financial relations. My name is David Maina, for those who are joining us for the first time. So public relations, financial public relations, one thing you must know is that it's one of the strategic public relations activities. Financial relations is one of the strategic public relations activities, among many others we'll be looking at in this particular unit. So when you talk about financial relations, it deals with an organization having a good financial relations with institutions, financial institutions. For example, we can be university, and this particular university needs funds. It needs money. It needs money or funds to purchase maybe a new piece of land, a new parcel of land. Or we need money to do what? Pay our employees. Or maybe we need money to diversify ourselves. Where do we get the money from? We will get the money from financial institutions. And we cannot get money from financial institutions, but all our relations with this financial institution is not good. Like, for example, we take loans and we don't pay on time. We don't do what we call, we don't honor the agreement that we have made with these financial institutions. Now, what happens that these financial institutions are going to blacklist us. And once they blacklist us, they wait until we pay our loans. And then from there, we will never have a good relationship with what we call these financial institutions. So therefore, we are saying this, the company, it has to deal with all its stakeholders simultaneously. So it can be very difficult to develop and deliver consistent message to several audiences, particularly if the PR function is not the responsibility of one department agencies, which are also used to deal with issues and crisis management. Remember, issues and crisis management is another strategic public relations activity. So in financial markets, agencies are increasingly used to organize the communication aspects of mergers and talks. So the main issues which communication strategies address are confidence, competition, and competitors. Communication strategies draw on expertise of PR agencies. So you have heard of mergers, we have heard of organization coming together to form one particular organization. We have heard of what we call amalgamation, where two companies, one company swallows a small company and they become one company. Those are called those are issues to do with financial relations. Like you will see a small bank being swallowed by a big bank, or a big supermarket swallowing a small supermarket, or maybe two giant organizations coming together and becoming one organization. Those ones we are going to learn here today. So we are still on the introduction. Financial public relations is also known as financial communication. And it is all about providing financial information pertaining to the company's performance, pertaining to the investors' community at large. It involves conveying all financial sensitive information and data of last year, including major capital expenditure undertaken, profitability, performance, and so on to the stakeholders. I'll keep on repeating this word, stakeholders. Stakeholders are many people that depends on this, on the organization. Now, stakeholders are, for example, we have the community. Community is a stakeholder. We have trade unions. We have political leaders or opinion leaders. We have the government. We have potential employees. We have employees. We have distributors. We have suppliers. We have wholesalers. We have retailers. We have consumers. All these people are called stakeholders. Now, when you talk about financial communication or financial relations, it is about communicating to the public or to the stakeholders about the current state of the organization or the current state of the financial organization. For example, we have had, it is mandatory here in Kenya. Those organizations that operate in Kenya, for example, the bank, it is a must that they must do what we call publicize in the national newspaper their financial statement. Now, this financial statement, it tells us assets, the liabilities, and the profit that the organization has made in the past, let's say, for example, 1 year, in the past 6 months, something like that. Why then do we have to do that? When we advertise ourselves, we put our financial statement in the newspaper. People are able to see our liabilities, are able to see our assets, how much assets we have and how much it costs. And that way they can tell that this organization is a good organization that we can invest in. For example, if I am an organization, I have been here for the past maybe 15 years. And ever since I have been there, I have been making profit. My assets are worth billions of shillings. My liabilities are not many, very few. And maybe there is somebody, maybe I am a bank, somebody looking for a bank to invest in, or somebody or an investor looking for a bank where they can have a relationship with, be looking at how stable am I, for how many years have I been in operation, and from all those years, have I been making losses? Because nobody wants to invest in a bank that makes losses. So that is the most important part of financial relations, also known as financial communication. Financial communication is not only for banks, also can be for other organizations. It is not only for banks. We continue. So until the mid-1980s, there is a background here. Competition among various types of financial institutions was severely restricted by the law. So in other words, there was no competition among various types of financial institutions. Like a bank could not compete with another bank in terms of advertising that our bank is better than this one. We did not have competition among various types of financial institutions because it was restricted by the law. But now today, financial institutions previously limited to only one segment of the market are engaged in expanding their activities across the whole financial spectrum. So a major strategic issue for this larger retail financial organization is to reassure purchasing public they are sound. That's why we do what we call financial communication. We are trying to tell the people that we are okay, we are good, we are stable. Come and invest with us. We will not regret. The other day, we heard of Direct Line Insurance. Direct Line Insurance, when you look at so many matatus in Kenya, they are insured through Direct Line. And as we speak right now, Direct Line is no more. But on the advert, we could see that it is doing very well. But as we speak right now, Direct Line assurance is not there. So that is one thing. That's one thing. What about that person who invested with the Direct Line immediately? And then, after few months before. And then now it has gone under. That person has lost. So then, when we are doing what we call financial communication, we are reassuring the purchasing public that we are sound, that we are trustworthy. You can trust us with your money, and that we are able to survive in the long term. That we have survived for 20 years. We have survived for 40 years. So we can survive for the next 40 years. Like, look at an organization like Coca-Cola. If you are to invest in that company has been there for a very long time. If you are to invest with a company like East African Breweries Limited, it has been there for a very long time. So you are sure that it is not going to collapse the following day. You are trying to have what we call trust. You are trying to create trustworthy, and you are also trying to tell them that we can survive in the long term. Confidence in financial products and the institutions that delivered them has been shaken by numerous examples of instability. So we have heard of banks collapsing. We have heard of banks going insolvent. Like, for example, the insolvency of, we have so many banks that have gone under. We had a bank called Trust Bank. That bank went down. We had a bank called, I don't know, the Spire Bank is still there. I'm not so sure. We had so many banks, so many organizations. Supermarkets, we have seen them going down. Here in Kenya, we had Nakumatt going down completely. And when you look at the products of Nakumatt, they were of high quality, high-end products. The prices, the way it was so organized, you could not even think that it can go under. We also had another supermarket that went under, and so on and so forth. So collapse and insolvency of one of the ways in which financial PR differ from other forms of PR is that product is very sensitive. When you talk about financial PR, the product is very sensitive. And what is the product? It is the money. Money is very sensitive. Money can make people wake up one day and withdraw their money from your institution and leave you there. So the product is very sensitive. So financial PR then, it must address increasingly sophisticated audiences who are interested in issues of liquidity, who are interested in what we call internationalization, who are interested in growth in company size, who are interested in flexibility of capital market funds, who are interested in rapid privatization and relative importance of institutional investors, and so on and so forth. Also, efficiency, effectiveness, and ethics. Ethics is very important. Like, if you save your money with a certain organization, ethics is very important, because ethics tells you whether your money is safe or not. Ethical behaviors. I've had people in so many countries, especially in Africa, to invest in a certain organization. Like there was another organization here in Kenya where people invested so heavily. They knew it was a construction company, that they knew very well that this construction company is going to build houses for them. So they invested, only to come and realize the company was stealing money from them. How do you feel? It is very unethical. So we are saying ethics, very important. Transparency, very important. People want to invest in a company that is very transparent, ethical companies that are very efficient, companies that are stable, companies that are credible, companies that all those things you may think of. Nobody wants to invest their money, then it gets lost overnight. Because even getting this money is very difficult. The key audiences of financial relations specialists are those who have the ability to make the decision. Key audiences of financial relations specialists are those who have the ability to make the decisions. These are, number one, we have partners. Like, for example, you can find an institution like a supermarket. It has partners. Partners are people that work with a particular organization. Like you'll find a supermarket has partners such as Woolworths, has partners with what we call partners with KCC, partner with this, partner with that. But two, employees. Employees are very important in an institution, because if you don't have good employees, then these employees will engage in what we call unethical behaviors. And when employees engage in unethical behaviors, when the stakeholders knows that your employees are like this, the employees can make the stakeholders not to invest with you. Employees are there. We also have investors. Investors are people who have decided that we want to put our money in your company. We want your company to, as it grows, we want what we are investing with you to grow. That if I invest 100 billion with you, after 20 years, we'll have the 5 times what I invested with you. So investors are people who put their money there, who put their what we call their resources in your company, so that at least that resource can be multiplied, tripled, or something like that. Then we also have depositors. Depositors, especially in bank, people who deposit their money in bank. And by the way, do you know that when you deposit your money does not stay in the bank? Your money is taken by the bank, and then the bank does something with your money. To invest, or maybe those people who are coming to borrow your money, they borrow your money and then it comes with interest, or they invest with other things, so that it can bring what we call profit. We also have debenture holders, also have insurance companies, investment companies, we have mutual funds, individual stakeholders, we have secured and unsecured creditors, we have stockholders, portfolio managers, rating agencies, commercial bankers, security analysts, and pension funds. These are the key audiences of financial relations specialists. By the way, they are not all of them. So the above category of investor public is not exhaustive, but it is inclusive. It may also include stock exchanges. It may also include broker vendors, government officials, regulatory agencies, and other external publics. So the list is not exhaustive. So from there, we look at the web of interested parties. So when you talk about the web of interested parties, we are saying what? That new publics are emerging. New publics are emerging, or new publics emerge, and they combine with the existing ones. New organizations emerge, and they combine with the existing organizations. The way atoms combine together to form what we call molecules. So this is certainly the case in the financial sectors. We have seen organization collapsing. We have seen organization merging with other organizations. We have seen amalgamation of organization, a big company swallowing a small company. So this is certainly the case in the financial sector, where deregulation, globalization, technology, and service innovation has caused mass alignment of corporate financial holdings and dealings. So publics of interest to the financial PR managers cannot be viewed in isolation. So there is an overall need to promote a constant image and to provide consistent information across publics, groupings, also identifying publics is complex, as many wears several publics hats. So all publicly quoted companies need to consider their image in the financial world as investor confidence, share price, and asset value depend on this. So having said that, we are saying that publics for stock and currency markets, PR managers attached to stock and currency markets, promoting the image of their institution, must consider the needs of institutional investors. That they must consider the needs of institutional investors. They must consider the needs of brokers, the needs of financial analysts, and the media. Because when you look at large institutional investors such as government, it requires information about the regulatory health of these markets. You cannot just start a company here in Kenya. The government also wants to know how you are faring, are you making profit? Are you making losses? Because when you look at, like, for example, financial institution like banks, that's why we have what we call the central bank. The central bank regulates all the banks in Kenya. If you look at financial institution like SACCO, SASRA is the one that regulates financial institutions. If you look at insurance companies, there is what we call insurance regulatory authority that actually does what we call, that regulates all the insurance companies. That in case this organization is not able to do this, that regulatory authority does what we call, it deals with you, or it comes in. For example, if an insurance collapses and maybe you had premiums with them, where will you go as a person or as an institution? Like the way Direct Line went under just the other day. I know there are people who had insured their vehicles with Direct Line. Maybe their insurance had not expired. Where do they go? Where do they put this complaint to? Then they go to IRA, Insurance Regulatory Authority, so that it can be able to make sure that these people are compensated, or these people are comfortable. So the PR requirement is to make known, understood procedures for the legal and effective working of the exchange, and to manage the interaction with the media when a crisis occurs. So as the PR practitioner, like what happened in Direct Line, How did we come to know? It's the media that exposed that. So as the PR, it is the requirement of PR to make known and understood procedures of legal and effective working of the exchange and to manage the interaction with the media when a crisis occurs. Like that is a crisis. When you see a whole company closing down, that's a crisis. How will you then treat the media? How will the media now, how do you expect the media to treat you? Something like that. So appropriate messages have to be delivered consistently through the media to the general public. People need to know what happened. How are we going to get our share of the company? I invested in that particular company. What will happen to me? So the media needs to communicate to these people. Of course, it needs to rely with the organization. So the same case we said, when a crisis occurs and you send the media away, or you bar the media from getting the information, the media has its own way of getting the information. And most probably, the information that they will get will not be favorable to your image. So the best way is to welcome the media to your organization, give them all the full information, because again, when you give them the information that they did, they will not go there collecting information. So hata kama, even if you'll be there and you have got some information that you want to give the media will not listen to you, because it will tell you, actually what you need to give me have already been given by the right person from that particular organization. So that is it. So PR strategies, let's look at PR strategies used in what we call financial PR. So as financial institutions become larger to fulfill global strategies, the PR functions also becomes more complex. As we have so many and a very big financial institutions, as they become so big and larger, and as they diversify themselves to fulfill what we call global strategies, now the PR functions become more complex. When you become big, you create more complexity. So to regularly assess what publics to address, we have the person known as Pavlik, 1987. He suggested that public audit or PR audit be designed to include an audience identification study. When you do audit, you're trying to look at the root cause of something. For example, if an organization collapses, PR needs to do what we call audit, the root cause. What was the cause of this organization collapsing? So we have to regularly assess what publics to address. Pavlik 1987, he suggested that PR audit be designed to include an audience identification study. We need to identify the audience. So there are four basic steps to identify the relevant publics, identify issues of concern to potential publics, and measure their perceptions and attitudes. For example, somebody may ask you, what is your perception concerning organization XYZ? What is your perception concerning bank ABCD? Like if you ask me about the perception about certain banks, I'll tell you, I don't like this bank because of ABCD. I don't like this bank because of ABCD. I like this bank because it has got this service. It cares so much about my money, and I feel safe when I invest with this bank or when I deposit my money with this bank. Like there was a bank that I was involved in. Every time I go to check my money, I would get every end of month, they have deducted 3,900. When I tried to follow it up, what is happening? That I'm getting a deduction every month of 3,900. The bank could not tell me and could not even open up what is happening. So what did I do? I said, I'm not going to play this game for long. So I opted out of that bank and I opened another account in another bank where I felt safe, where I felt that my money is safe and it is not it is not disappearing like that. So we need to do, after that, after evaluating the organization's then we evaluate the organization present standing with these people. You need to know what is the organization present standing with the people, with the customer. Then measure the power of each public. Then from there, we go to our introduction about investor relations. Now, when you talk about investor relation is all about the communication between a company's corporate management and its investors. That is what we call investor relations. Remember, we have talked about financial relations. I don't want to confuse you. Let me go back. Whatever we were doing right now, like for example, we have done an introduction of financial relations. We have looked at financial relations. Now we are done with what we call financial relations. Now we are on investor relations. Remember, financial relations, we said that it can also be called financial communication. Then again, we also have investor relations. Investor relations, it's all about communication between a company, corporate management, and its investor. It's a relationship between an organization and its investors. For example, I may want to invest in bank ABCD. That bank is called ABCD. So if I invest in that bank, I become an investor. So then my relationship with that bank, if there is any communication that will come from that bank to me, it will be an investor communication. Investor bank communication. So then investor relations is about communication between a company's corporate management and its investors. An investor is a person who has decided that I am going to put my 100 billion in this organization so that it can grow 100-fold, so that it can grow 50-fold, 10-fold, like that. So it is communication between companies, corporate management, and its investors, communication with its government authorities, and with its shareholders. By the way, an investor, maybe you may be asking yourself, what is the difference between an investor and a shareholder? I'll give an example. For example, when you talk about an investor can be a person who has a lot of money and he wants his money to grow. So he comes and invests with you. Maybe, for example, you are a bank. He comes and tells you, I am going to invest 100 billion with you because I want my money to grow by this much. So an investor has invested. A shareholder has bought some shares concerning the company. For example, I may be a shareholder of a company. I own 20% shares of the company. A shareholder is not an investor. A shareholder has got shares. So as the company grows, my shares remains to be 20%. So in case I want to sell, in case I want to opt out, I sell my shares to maybe another shareholder. Then I get my money back. Then I pull out. Those are shareholders. Investors, they are not shareholders of the company. But shareholders, they have a part. It's like, for example, when you have a cake. maybe for example, we have bought a cake. We are 5 of us. One of us contributed 1,000. The other one contributed 300. The other one contributed 100 shillings. And the other one contributed maybe 500 shillings. So when you are coming to share the cake, we will share according to the way we contributed. That person who contributed 1,000 shillings, he will have a bigger share as opposed to that person who contributed 100 shillings, and as opposed to that person who contributed 50 shillings. So the more shares, the more money you contributed, the bigger your cake. That's a shareholder. The investor, you have a cake. He comes and invests and tells you, I am investing in this cake, so that this cake can grow and grow and grow. And as it grows, my money will grow with you. So that when something like that. So I hope that clear, that there is a clear picture of an investor and a shareholder. Maybe you may be asking, can I be a shareholder and then be an investor? Now, those are questions that you need to ask yourself. Can I be an investor, be a shareholder at the same time? Can I invest my money and also I am a shareholder? I think the best thing you can do is to buy more shares of the company, so that at least you have 70% of the shares of the company. So we also have the financial community. So communication between investors, it's a relationship about communication between companies, corporate management, and its investors, the government authorities, the shareholders, and financial community. Now, what does it involve? Investor relations. It involves handling investors' events. It involves releasing financial reports and regulatory filings. It involves handling investors, analysts, and the media queries and complaints. So the main focus of investor relations is on ensuring that a company's investors get an accurate account of the organization's financial affairs through proper disclosure of key facts. So what are we saying? We are saying this, investor relations is about investing, having a good relationship with your investors. For example, if a company is closing down, don't hide anything from your investors. Tell them. If there is a law that the government requires you to adhere with, let the investor know. Don't hide anything. Communication must be between the communication that must be between you and the organization, or the investor and the organization, must be very clear. Don't hide the investor anything, because he has invested a lot of money with you. If the organization is collapsing in the next 1 week, the first person to know is the investor. The first person to know is the shareholder. The first person to know is the government and authorities, and also the financial community. Those are the people that should know all those things that are happening. So investors plays a major role and a vital role in the success and growth of a company. Just like I've given you an example of a cake. We have contributed. Somebody has contributed 50 shillings. Another has contributed 1,000 shillings. Another one has contributed 500 shillings. And another has contributed 500 shillings. So when we buy the cake, we are going to share the cake according to how we contributed. So with the one who contributed 1,000 shillings, get a bigger cake. The one who contributed 50 shillings will get a smaller piece. Now, investor, they play a major role. They are not shareholders. They play a major role and a vital role in success and growth of a company. This cake can grow. we can diversify this company. If this company is in Kenya only, we can open another branch in UK. We can open another branch in United States of America. We can open another one in Burundi. That is the work of an investor, to see the company growing. You know, as it grows, his investment is also growing. We are not going to call it shares. His investment is also growing. So fundamentally, the role of investor relations is to create an awareness and an understanding of the companies among the investors community. Create an awareness, be open-minded, be what we call be open-minded, be transparent. Anything that happens in the organization, tell your investor. Because if you keep them behind, I mean, you keep them in the dark, and they come to realize later that this was happening in the organization, and you never told them, they can pull out. And the moment the investor pulls out his investment from you, the chances are you're going to be affected tremendously. So, in other words, investor relations is creating an awareness and understanding of the companies among the investors community, as well as to help listed companies gain access to capital, achieve liquidity in the market, and attain a fair valuation of the company. Because of the fact that it is crucial for companies to maintain strong, transparent relationship with investors. If you are firing some people in the organization, the investor must know. Can you survive without investors? Yes, you can survive. The investors, like what we call, it's actually, they reinforce the company. They reinforce the company. They make the company achieve greater goals. That's the work of the investor. If you are seeing yourself being a local bank, the investor makes you now even starting thinking of being international, depending on kind of investment that he has put on you. That's how the investor is. It makes the cake grow and become bigger. So what does investor relationship consist of? It consists of securities, laws, compliance. So as an organization, you need to be compliant with legal requirements. If you're not operating in Kenya or in a country legally, you must be compliant 100%. You pay taxes, you have satisfied the government legally 100%. So investor relations involves security laws compliance, ensure that you are compliant to securities laws. It consists of finance, because a lot of money is going to be used. Investor relations consists of marketing. It also consists of communication. 4 things, very key: securities law compliance, finance, marketing, and communication. So therefore, investors need to be aware of the business, financial aspect of an organization they are affiliated to, and this information should be disclosed to them in a financial and transparent manner. So I kept on saying, as far as you're having investors, never hide them from anything. If you have fired the board of directors, tell them that they know how to handle that. If you are merging with another company, tell them that I am merging, or we are going to merge with another company, so that they can even advise you on what to do at all they have, if at all they need to, can advise you. Because decision made without investors being involved can actually make the investor pull out. The moment he pulls out, opportunities that are out there, you might not even get them. So while investor relations is a subset of public relations, it differs from regular public relations practices in some ways. Unlike other public relations activities, investor relations practices are required to be integrated with the company's legal and accounting department. Investor relations practices are required to be integrated with company's legal and accounting department. Investor wants to know, are we making profit from the accounting department? Are we making losses from the accounting department? We want to know, are we doing things legally? Because at the end of the day, if an organization goes down, the investor will lose. Imagine you as an investor, you have invested 100 billion in a company. This company is not doing what? Legally, it's not doing well. It is not compliant with legal requirements. The accounting department are giving out information that is not true. We are making losses. We are showing the investor we are making profit. The investor is there, positive, very happy, we are making profit. But the reality is we are making losses. So investors need to be provided with information so that at least they know what, if it's to save the ship, to save the ship. So investor relations also, it involves complex information such as companies' financial statements. The investor wants to look at the company's financial statement as he requires it, as soon as he requires it. And financial statements include what? It includes they need to see the assets. What is the worth of our assets? How many liabilities do we have? What about cash flows? Shareholders' equity, which must also be detailed in a company's annual report. All these things the investor wants to see. He wants to see the financial statements, the assets, the liabilities, the cash flow, shareholders' equity, and so on and so forth. Because he has invested heavily with you. So investor relations, therefore, they are also subjected to more regulatory, financial, and legal requirements by government or other regulatory institutions. For example, companies that deal with investment portfolios, such as money market funds, such as stock and bonds, such as real estate investment trusts, shares, where these products are regularly regulated by the Capital Market Authority, who ensure that the offerings or product portfolios by these investment companies are solid and they meet certain requirements in order for them to be advertised by the public. I hope that one is clear. That is the role of investment, the role of investor relations. Any question up to that point? Is there any question? Any question? So if there is no question, we come to the end of our today's lesson. If there is no question, that marks the end of today's lesson.